Thank you for joining me today. It's a pleasure to have you here and to be delivering the second of our Bolster Your Business series, Cash is King. I ran one about saving tax a couple of weeks ago. If you haven't watched that or seen it or would like the link to it, it is on our YouTube channel, or if you drop us an email, the details are further in this presentation. You're more than welcome to have a copy of that. So today we are looking at Cash is King. So we're using Zoom. The main thing is I've got you all on mute. If you've got any questions during the session, if you could just pop it on the chat and I'll answer them as we go along. And again, if you need to leave the meeting, you can do at any time. And as I've mentioned, the session is being recorded. So if there's something that you want to look at when the session's been done to cover again, you're more than welcome to have a copy of the recording. So next, a bit about myself. My name's Carrie Stokes and I'm the director at Spotlight Accounting. At Spotlight Accounting, we work with business owners to help them achieve their business vision. We work with owner-managed businesses that want to develop and grow, but more importantly, are more prepared to take action to develop and grow to reach their goals. Whilst we're based in Shropshire, we're a cloud-based accountancy practice, so we do deal with businesses and have got clients all over the UK. And again, before I start, I just want to point out the usual disclosure that the information in this webinar is for educational purposes, it's of a general nature, and it does not constitute any individual tax or business advice. If you do want any more detail about anything I've discussed today, please do not hesitate to get in touch. The office phone number is there and the email hello@spotlightaccounting.co.uk. If you want copy slides or previous videos, please just drop us an email. We're here to help. So what are we going to cover today? I'm going to do a brief introduction. Then we're going to look at the key differences between profit and cash. Then we're going to look at your business's cash conversion cycle. I am going to try and put this into more of a plain English terminology than the technical ones. Then we're going to look at how you can assess where your business is now. Then we're going to look at ways that you can improve your cash flow. What next steps you should really be taking. There is no point you being on a webinar like this if you're not going to take some learning and even implement one new thing. Then what action are you going to take? We're going to have some questions if you've got any, and then we're going to close. So, have you ever heard the saying, turnover is vanity, profit is sanity, and cash is king? Cash is the lifeblood of every business, and without enough cash in it, even the most profitable businesses will go bust and fail. As a business owner, it's really important that you understand the cash that's coming in and the cash that's coming out of your business. And more importantly, that you have enough cash within it to keep trading. So known fact that 90% of small business failures are due to cash flow. And again, without cash, it's quite simple, your business will not survive. So again, it's really fundamental that all business owners understand what their cash position is and how it works within their business. So do you ever feel that your business is running you rather than you running the business? It's really common that small business owners feel like the business is consuming them, and cash and the ability to pay bills being one of the key things that keep them awake at night. So how can you get in control of your business's cash situation? Oh, hold on, I just need to admit someone in. Firstly, you need to understand it. You might have been told in the past by your accountant or another business advisor that you are making money, but you don't know you're making a profit, sorry, but you can't understand why you haven't got the cash in the bank to pay your bills. So it's really important you understand why there's no cash in the bank. Secondly, you need to understand where you are. Now, by understanding where you are, that is how much money you've got in the bank, what is due to be paid in, and what is due to be paid out. Then once you understand how the cash runs through your business and you understand where you are now, you can then look to take action to improve it. Now, I always find it easier to work with examples to try and put it practically. So today we're going to use Windows and Website Limited. Windows Limited is a windows and door manufacturer, and they supply to the trade. So by supplying to trade, I mean they supply to builders only. They don't supply to the public. Website Limited is a website development company. They're based in an office and they've got a team of 10. Another key point is that Windows Limited and Website Limited are both growing businesses. So first, we need to understand. So it is a common misconception that a profit made by a business will show in the bank account. Profit and cash are two different things. So the bank balance will not necessarily reflect the profit that the business has been made. So what is profit? Profit is the balance left after you deduct all your business expenses from your income. Cash flow is the money that comes in and out of your business. So based on the definitions on the previous slide, it is really important to realise that a profitable business can go bust because it runs out of cash. And a business that is making a loss can survive as it might have investors that can pay money into the business to support the loss, or it might have loans from the bank to support the business growth. So now we're going to look at the key differences between profit and cash. So on the table, I've got the key differences between profit and cash. So the first one is VAT. You collect VAT on behalf of HMRC from your customers, and then you pay VAT on behalf of HMRC to your suppliers. And the net amount you pay over to HMRC. So if you receive £120,000 from a customer, £20,000 of that money is HMRC's and not part of your profit. So that needs to be set aside. Loan repayments. If you borrow £120,000 over 10 years, £1,000 of your loan repayment will be repaying your money back. While this is not an expense in calculating profit, you need to make sure there's enough cash in the business to make these loan repayments. Interest on loan repayments. The interest element of a loan payment is an expense when calculating your profit, and it also comes out of the cash. One of the main big differences is when you purchase assets. So for example, if your business buys a van for £30,000, this will immediately reduce the cash in your business by £30,000. You may then sell it in 4 years' time, for £10,000, and that will increase the cash value by £10,000. But for profit purposes, the value of the van is written over the period it's used. So there's often a discrepancy between cash going out for assets and the cost going through the profit and loss account. So the other main difference between profit and cash is timing. Firstly, there's what we call debtors' days. Debtors' days are the time it takes your customers to pay you. So the longer a customer takes to pay you, the less cash there is in the bank. Creditor days. This is the time you take to pay your suppliers. The longer you take to pay your suppliers, the more cash there is in the bank. Stock days. So this is how long stock physically sits on your shelves. The longer the stock is held on your shelves, the lower the amount of money there is in the bank, because you're obviously not getting the income in from sales and you've paid for that stock. Annual invoices such as insurance. If you pay your insurance annually, you might have, for example, a £12,000 insurance bill. That will go out on month 1. So that means your cash will be a lot lower than your profit until the end of that insurance policy. So putting this into a practical example, Windows Limited. They've been told they've made £100,000 this year, but there is absolutely no money in the bank. So how can that happen? Well, they've written £20,000 off their assets. So what that means is if they've bought a van or equipment 2 years ago, the cash has already gone out the bank, but from an accounting purposes, is writing it over 4 years. So obviously that won't have affected cash this year. They have, however, spent £30,000 on new machinery in the year to facilitate the business growth. It's also had to increase its stock levels by £50,000 with the increase in sales. As sales have increased, so has the amount owed to debtors. VAT has decreased by £15,000 because they've recovered more because they've got more stock, and £12,000 has been paid off in a loan in the year. And as you can see, just from this basic example, it doesn't include all movements, but it includes the main. The cash movement is minus £27,000. And as you can see, the bulk of this is funding the business growth, which is the amount of money they've had to invest in new stock, the amount of money outstanding from sales at that point in time, and the amount of money that's gone on loan repayments. So to fully understand the cash flow in your business and the timing, you need to understand what we call your working capital cycle. This is basically looking at the timing of cash coming in and out of the business. Using our 2 examples, the window manufacturer will need to order stock and materials to make the windows. They will then pay for this stock between 7 and 45 days after they've purchased it. They need to hold enough stock in the business to manufacture the windows and doors. They'll then invoice the customers when the goods are delivered. And as they're supplying trade, the customers can take between 30 and 120 days to pay for the invoice for the goods. It is only then that the cash hits the bank for the sale. The web developer, however, is quite more simple. They invoice the customer when the website's finished. The customers then pay between 30 and 60 days, and then the cash is received in the bank. And once you understand the movement of cash through your business, then we need to look at your cash conversion cycle. The cash conversion cycle is basically the amount of time between you paying for goods or starting paying staff to carry out a service to the time a customer pays you. So let's look at the web developer first, because this is a bit more simple. The website development starts on day 0. Payroll gets run at the end of the month, so we'll say day 30. Takes 60 days to develop the website, so that's when the website goes live. It then takes another 60 days for the client to pay, so the client pays on 120. Now, in this case, you can see the cash conversion cycle is 90 days. So the point from which staff are being paid to develop the website and the customer pays the company is 90 days. Using the same model for the window manufacturer, stock is ordered on day 0. The supplier is paid on day 45. Windows are dispatched on day 75. Payment received is on day 160. So the gap between paying the supplier and receiving payment from the customer is 115 days. So that's nearly 4 months. So how can we learn from our cash conversion cycle? Well, firstly, the shorter the better. The shorter the time period from when you pay for something to pay for something that you're manufacturing or providing to customers, and the point at which the customer pays you, the shorter that is, the better, because there'll be more money in your bank. Now, so how do you calculate yours? Using our examples, the web designer will need to know average work in progress days. That's basically how long a website takes to be developed, and the average debtor day. So on average, how long do customers take to pay you? The window manufacturer will need the average supplier payment in days and the average stock holding days and the average work in progress days and the average debtor day. So what that means in English, how long it takes from ordering goods to when you actually pay for them, how long stock actually sits on your shelves, how long it takes to manufacture the windows, and how long your customers take to pay you. And once you know this, then we can look at the impact, or you can look at the impact of shortening it. So again, using our examples of our web designer. In this example, he's got £1 million worth of sales, £500,000 in salary, and £200,000 of overheads. So if he focused, or they focused, on getting their customers to pay in 30 days rather than 60, and getting the web development down to 45 days, it would increase the cash in their business by 124,429. Now, this is a rough example of a client we've actually worked with. So again, just an example of businesses this size, how getting on control of your cash can really help put more money in your bank. The next stage to understanding it is to look at a cash flow forecast. If you want an example, or the Excel spreadsheet that is, you are more than welcome to drop us an email and we'll send it over. So the way that we run our cash flow forecast is we have 5 weeks, then we run into months. And this is using the web designer as an example. At the top are all the bank receipts. So we split it by project work, and the web designer also has £15,000 worth of support revenue a month. And then at the bottom, you have all the costs going out. So as you can see from this example, the web designer is going to hit a deficit in May and August. So once you've understood this, and you know that you know how long it takes for customers to pay you and how long it takes for cash to come through in your business, you can then look at how to improve it. So first, key way of improving cash flow in your business is looking at customers and looking at, what you're looking for here is how they can pay you more quickly. The first thing businesses need to look at is whether they've got a credit control process. Do you credit check your customers? Do you contact customers before payment is due? Do you contact them in more than one way? Do you charge them late payment interest? Do you put customers on stop? Now, do you actually put them on stop, or do you threaten it? And again, do you send letters before action for court? The next one is direct debits. This is utopia. So small businesses can use a platform such as Go Cardless. So in the case of the web designer, if they've got customers on a support revenue contract, then are they using direct debits to receive payment from their invoices? Not only do they get paid when the invoice is issued, but also it saves admin time on the credit control process and chasing the debts. Customers can also pay you by standing order, so that's automatically made. So for example, you might rent out a property, so you might want to put the rent on standing orders, so that automatically comes in. Do you use pro forma invoices? So pro forma invoices is where you ask for payment up front. So if you credit check a customer and they've got a bad credit rating, are you using pro forma invoices to get the money up front as a way to mitigating your risk and keeping the cash within your business? You can take stage payments. So for this web designer, they could take a percentage on order, a percentage on when the test site is released, and they could take a final percentage when the final site is released. You can also use early payment discounts. The only sort of issue with early payment discounts is you need to make sure they're built into the profitability of the product or service you're selling it. If you're offering a 3% discount and you're only making a 5% margin, that's most of your profit gone on early payment discount to your customer. So next we can look at stock control. So the idea of stock control is making sure you only have sitting on your shelves what you need and you haven't got excess stock. So have you got a proper computerized stock system in place that monitors stock levels and ordering levels? So you know when you're ordering, you are only ordering the stock that you need. Do you know how much excess stock you've got? So stock that has been sitting on your shelves that you don't need is money that could be in the bank. So what can you do to get your stock in control in place to make sure you are only holding what you need? Can you go around and do a stock take, highlight the stuff that is excess stock and work to get that down? What's your policy with slow moving stock? Again, slow moving stock is cash that is sitting on your shelf. So if you've got obsolete or slow moving stock that you just don't think you're going to use or it's unlikely you're going to use, is there a way that you can convert that into cash and maybe not sell to your customers, but sell through a different channel? Next, we're going to look at your suppliers. Can you pay less? Are the subscriptions going out of your bank account that you don't need? Is there an expenditure that you've got that is not effective? So are you spending lots of money on marketing and not getting a return on your investment? Can you pay slower? Do you pay your invoices as you come in? Now, it would be surprising how many business owners actually pay business invoices as they come into the business. Business owners are busy people, sorry. So if you're busy and you're just paying invoices as they come in because you might forget or you haven't got a proper system in place, obviously that is cash going in out of your bank earlier than expected. Can you negotiate better credit terms with your suppliers? So if your customers are paying you on 30 to 60 days, can you negotiate 30 to 60 days payment with your suppliers? Do you have budgets in place? So if you don't, why don't you? So if you do you compare it to actual expenditure so that your costs are kept under control? Then finally, staff. Are your staffing levels right? Understaffed businesses can cause a reduction in sales. It can cause bottlenecking. Overstaffed businesses can end up with costs, additional costs to the business, and obviously having an impact on your cash flow. Next, we're going to look how the government can help your cash flow. First, you can reduce your tax bill. I covered that in the last webinar. If you want to look at ways that you can possibly reduce your tax, drop us an email and we'll send that over to you. You may be eligible for research and development tax credits. So most people imagine research and development tax credits only apply to businesses that have a laboratory, with people in white coats. It's a lot wider than that. So if you've made something that extends a field of science of technology, so by this you've made something faster, cheaper, better, then for every £1 you spend on this, you get £2.30 in tax relief. So for example, we've got some software developers that have to write specialist software, and in a specific example, it was linking a booking system to an accounting system, and there was nothing on the market that would be able to do that. So because this was extending the field of technology, they qualified for research and development relief. So if you think you're doing something that is a potential claim, get in touch and we can have a look for you. Next is grants. There have been a lot of grants throughout COVID. Most of these have gone, but locally, if you look on the Marches Growth Hub, there are lots of details for Shropshire businesses on grants. There are particularly a few for business growth. So again, it would be, you need to make sure if you are investing in equipment or new premises, that there may be grants to cover this rather than it all coming out of your pocket. Next, we're going to look at lenders. So let's take the window manufacturer. The increase in stock and the increase in debts resulted in £90,000 less in the bank, and this is due to timing. So the business might need to borrow to bridge the cash flow gap. So what sources of lending are there? Firstly, there's bank loans and bank loans from mainstream banks. There are also alternative lenders that are outside of the traditional bank. You can factor your debts. Now you can finance them on the whole debt book. Some lenders will actually look at specific invoices. Factoring can be expensive form of finance and it can be difficult to get out of. So if you do enter a factoring facility, you just need to make sure you've got your cash flow and your business plan showing that it is affordable and you can get out of it long term. Then look at asset finance. Going back to the example with the window manufacturer, they'd spend an amount of money on a van. Now, if they finance that over the period that they use the van, it would free up cash within the business so that they can continue funding the business growth. So next, we're going to look at how investors can inject cash into the business if it's needed. So do existing shareholders and directors have personal funds they can loan the money? Interest can be a lot lower. The only thing I would say is if you are looking to put more money into your business and you keep pumping money into the business, is put your investment business hat on, not making a decision from the heart. You know, prepare a cash flow, prepare a forecast, and make sure that the business will have the ability to pay it back. Can new investors be brought in? I mean, have you got ambitious growth plans to grow your business? You know, you might need a business angel to get it to the next stage. Is there a mentor that you can use that might be brought into the business to help you with the business growth? You have got to remember that if you bring new investors in, they will take a portion, they will have a proportion of the ownership. So they will have rights to dividends and a value to the business. If sale is an exit path you're looking at, again, it might be beneficial to have investors, but please remember they are taking a chunk of the pie, so to speak. Can family members loan you money? Now, a word of warning with this to avoid any conflict with family members. I would say, if you are going to borrow money from the family, that you get a formal written agreement in place that everybody sticks to before the lending happens. So, in summary, insanity is doing the same thing over and over and again and expecting different results. That was Albert Einstein's famous saying. Without business, your cash will not survive. So what one action are you going to take as a result of this to improve the cash flow in your business? It might be understanding how long it takes for cash to come in and out of your business. It might be that you're going to improve your credit control process. If you need an example credit control process, we can get one over to you. It might be that you're going to go and do a stock take and have a look at how much money is actually sitting on your shelves rather than in the bank account. Write it down, and if you write it down and email it us, we will come back in 30 days' time and chase you to see if it's been done. The email address as before is hello@spotlightaccounting.co.uk. So next steps. These are what I would be recommending to most small business. Get to grips with your cash conversion cycle. What can you do to reduce the time it takes from money going out of your business to when it comes in? Prepare a cash flow forecast and review it regularly. It doesn't have to be a complicated three-way forecast that balances to your profit and loss account. It can just be an analysis of money due in and out of the business over the next 3 months. I would recommend you do 3 months as a minimum so that you can have a look from a long term, because if you need cash in 3 months' time, you're going to need to know now how much it's going to be, and how you're going to get it. And like I said before, what's one improvement from this that you can roll out into your business? So how can we help? We can send you out our cash flow template. We can have a cash flow and profit improvement meeting. We can also prepare or help you prepare, if you wanted to, a cash flow forecast preparation. And we do provide cash flow management coaching. If you're interested in any of these services, please get in touch. And on that note, has anyone got any questions? So just thank you for everyone in participating in the webinar. I know your time is precious, and I really appreciate you being spending it to listen to me talk about cash. And anything we can do, please contact us at hello@spotlightaccounting.co.uk. Thank you very much. Thank you for the comments in the notes. I do appreciate it.